We want to welcome you to our call today with Ed Newton, CPA, CFP, and President of Newton Financial Network. On today's call, Ed will be talking with Troy Patton, Portfolio Manager for the Newton Financial Network, and discussing the 2013 mid-year investment outlook. If you're not already a client of Ed's, he's originally from Huntington, West Virginia, has a degree in accounting from Virginia Tech, and a master's degree from Liberty University. Ed landed at Arthur Andersen and Company in their tax department, and then began his CPA firm in 1977. Ed's a CPA and a certified financial planner, and he's uniquely positioned to help his clients achieve and sustain a worry-free retirement. And if you do know him, you know Ed has also been a commercial pilot for a major airline since 1982, and his current weekend routes are to London, England, and Frankfurt, Germany. Ed, good morning and welcome to the call.
Good morning, Jeff. Thank you very much, and I want to welcome everyone to the call. As we typically do on these monthly calls, we have a nice crowd today, and glad to hear that. And I will also say that a little bit larger than normal, which is not surprising. Anytime we are fortunate enough to have Troy join us on the call, we typically get more people interested. So that puts a lot of pressure on you, Troy.
No problem.
Do want to just take a moment to introduce Troy before he talks. It's coming up on 2 years now. Troy has been our portfolio manager. Troy is the president of Archer Investments and the portfolio manager for the Newton Financial Network private accounts. So with that in mind, Troy, I'm just going to turn it over to you and let you make the comments as you feel necessary. Talk about what's been going on so far this year as a review, and then also, if you would, give us an idea of what your thoughts are going forward for the rest of this year.
Okay, the great prognosticator. All right.
That's
okay.
Right.
Okay, well, I mean, that's a lot, but let me just kind of start off with really just talking about 2013, kind of, where we've come, because it's really interesting. At the start of the year, I always write a piece once actually at the end of the year, and then once kind of in the mid-year as an update as I retool our thoughts and our processes and make sure that our estimates are kind of in line with where we think the market's headed. And I'll tell you, at the start of the year, I really believed, as maybe some of you have seen in our annual update, that I thought the S&P 500. Getting somewhere, into the 1600s we would be pretty fortunate, and I thought maybe an 8 to 9% growth rate in the markets was going to be great. Quite frankly, we not only went past 8%, but we blew past 8%. Talking about the S&P 500, and really only saw a recent dip in June. Close, in some indices by about 7%, and then quickly rebounded back. And in fact, today, even the S&P 500 is only off maybe 1 to 2%. Now, the funny thing is, or the most interesting thing is, and I am actually a student of history, and I enjoy history and the history of the markets, is during this type of, economy and time where we have extremely low interest rates, generally speaking, we don't get very big market multiples. And what I mean by that is the stock market actually stays somewhat depressed when interest rates, for instance, on a 10-year Treasury are at 1%, or what I would call real interest rates, which is a short-term borrowing rate, is somewhere between 0 and 1%, which is where we're at currently. Now, recently, obviously, the bond market has been whacked over the head like whack-a-mole at a kid's pizza palace, and we've seen a meteoric rise in interest rates starting in the first half of this year in 2013, or in June, and more so in May and June. And in fact, we saw that continue into last Friday, the last trading day of the year. Even though we had a subdued market, the jobs number came in at about 195,000, and people celebrated that by driving up yields once again to about 2.74%, or even maybe a little bit higher than that before succumbing back down into the 2.6%. But let me just say this, and a lot of this is a product of the quantitative easing and what the Fed has been doing. And frankly, that's why the 10-year Treasury rate was at 1.5 to 1.75% for quite some time. And now that they discussed the mere fact that they're going to taper those purchases, the interest rate should rise. Well, it's not necessarily the case. The market obviously is its own animal, and we can't really control that because we don't have trillions of dollars to put to work every day. But given said that, I would say this, that the interest rate rise that we have seen is probably a bit overdone. And because, frankly, the Fed is still buying treasuries, right? So that means there's just a lot of people selling treasuries and different bonds. But if you are one of the lucky folks who has the ability to buy and hold here, and you invested in something like, for instance, like one of our funds, like the Archer Income Fund, where we're buying coupons of 5%. And by the way, we buy and hold. We don't trade bonds. We're not traders, but you'd be fortunate enough to still collect your interest rate. Yes, it may be a little bit lower if interest rates all of a sudden went to 7%, and now you could get 7% on the open market. But quite frankly, that's still not the case. In fact, most of the issues that keep coming across our desk are still below 5%. In fact, they're even in the 3%. So interest rates are still very low, okay? And quite frankly, I expect that to continue. I don't care whether the Fed is buying $85 billion or $45 billion in debt. I still think interest rates are going to continue to be low. The reason for that is simply this. There's not a lot of hiring. We've hired 195,000 folks out there in this last employment release. That's not that much. Unemployment is still at 7.6%. Our GDP is not growing very fast. Now, our debt to GDP has declined in the marketplace, but and there's always a but. It does not mean that we are going to see a big inflationary tail on the market. 3 years ago, I would have told you just the opposite. I actually, in fact, for 3 years, it's amazingly enough, you can be wrong and still be right. Our income fund did pretty darn well for the last since we've opened it. But I really thought interest rates would rise. But the reality is they haven't until now. But I don't expect them to continue to rise, and the reason is this. Adding 190,000 jobs is not going to create an inflationary attitude in the market. In fact, I think we're in for a slow process in the economy where real growth is very muted for quite a while, and a very good indication of this is quantitative easing. And I'm sorry, guys, I'm rambling on a little bit here, but it's quantitative easing. We've all known that it's been going on, but the reality is the money supply that has been injected into our economy. If anybody ever wants to go see some really good statistical examples, you can go to shadowstats.com and actually see what the real numbers are of unemployment, how they calculated them in the 80s, and then our money supply. Even though our money supply may have tripled over the last few years, the regulations, and I'm not talking Democrat or Republican, I'm talking about the regulations out of Washington from both sides of the aisle have stifled the banking industry. And by doing so, there's what's called a multiplier. And I know I'm getting into some real technical stuff here, but if I gave everybody on this call $10 and you thought you could go out and spend $10, that would be wrong. That'd be misleading. Is what the government has done is they've gone out and given everybody $10 and said, hey, by the way, you can only spend 4 of it. Okay? You have to keep the other 6 back as reserves. So what it's done is the banks' balance sheets have gotten tremendously better. They've gotten very solid. So the banks have really no fear of going out of business. They've basically saved them forever. But at the same time, they created all this quantitative easing, but the money supply has never gotten back into the economy. Now, at some point, if the economy does start to heat up and more lending takes place and the banks become stronger and stronger and earn more dollars, and they're able to lend those dollars, that will then cause inflation. And then a meteoric rise in the interest rates will probably promulgate some kind of setback in the stock market. But we've seen this happen a dozen times before in our past history, and it doesn't necessarily mean that the market is going to correct. In fact, interest rates can rise in tandem with the stock market as they have for years and years and years. In fact, 1/3 of the time since the beginning of the stock market, interest rates have risen in tandem with the stock market. Okay? So, sorry, Ed and Jeff, I know I'm kind of going on here, but
no, I think it's good information, and I think most of the folks on here, like to hear that kind of stuff, Troy. So
Okay. So is what I believe is what will happen, is what history tells us will happen, is when these interest rates can rise and real interest rates get from a 1% to 2% level, which is what we expect will happen, the multiples in the market will expand. So at this point, I mean, we've even said that now, quite frankly, the S&P 500 could finish the year at 1,650 to 1,700, which is another 4 to 5% higher than maybe where we are today. But frankly, not much higher, maybe 3 to 5%. That in our estimation is where we believe we will be today. Another good tell of that 3 to 5% level is earnings that are coming out of the big companies. Balance sheets have gotten tremendously better over the years, but earnings the only reason earnings have increased on these large companies and even the small companies is because they've been able to cut costs and increase margins. Revenues have not grown by a wide amount. In fact, revenues on the top 50 mega cap companies are actually 0%. They're not growing. So that tells me that yes, the CEOs and presidents can continue to keep the margins strong on the bottom line, but the only way they're going to be able to do that is to not hire very aggressively. And I think that's why we're seeing the employment ranks only at 195,000, when quite frankly we need it to get to 320, 350,000 per month to really get the economy going. And even at that point, that will hit earnings on the companies, but then it'll project us forward for the next 10 years. So right now, frankly, I see a lot of sluggish growth in the market, or in the economy, in the stock market. Inflation is muted at this point in time, only because of the regulation on the currency that Washington has promulgated on the banks, and frankly, I don't see interest rates moving a heck of a lot higher, except out of fear and greed. So, with that being said, Ed, that's kind of my 2 cents worth, which it may have been 10 cents or a couple dollars worth. I don't know.
Yeah, I think it's probably a couple dollars worth at least, Troy. Troy, take a minute and, if you would, talk to us a little bit about volatility from the standpoint of, we're seeing these 100-point swings in the Dow, almost on a regular basis. And share a little bit with us about how do I want to say that? How does it affect not necessarily the way that you guys manage our portfolios, but maybe give us a little bit more comfort in that we shouldn't be too worried about the volatility because of the way that we manage the portfolios.
Okay, yeah, sure. Well, one of the things, volatility is not necessarily your friend or foe. Volatility is just simply the price that the Mr. Market gives us on a daily basis. One day it may be higher, one day it may be lower. Now, the reality is the market volatility that we've seen is probably here to stay. And the reason is because we are truly a global economy. So, for instance, Alcoa reported earnings last night, and everybody thinks the market's up based on Alcoa's earnings. I don't think so. I actually think it was the increase in today's stock market is more based on what the CPI and PPI, which is Consumer Price Index, that came out of China, is actually a little bit hotter. That means that people are spending a little bit more money. Their economy may be growing a little bit more than what people thought over in China. So I think that's what's actually sparked the markets a little bit today. That obviously creates volatility. Now, tomorrow, China may come out with a different report, or Japan, or Australia, or Brazil, or the United States. So we're seeing more of a global economy, which creates more volatility. In our portfolios, we see volatility, but we also try to manage that volatility or even the risk in the portfolios that we manage. And the way we do that is we actually try to reduce volatility or reduce risk and believe in more of a slow and steady wins the race mentality, as opposed to saying, hey, gosh, we want to be in the top 50 high flyers out there, because that's all great when it's doing fine, but unfortunately when that volatility goes the other way and things drop 5% overnight, we don't necessarily want to drop 5%. In fact, we'd rather, depending on your risk tolerance, drop anywhere from 1 to 4. So we don't want to exceed that 5% drop. That's kind of our mentality of how we manage the portfolio, and we do that by every company has a certain risk index, and every company their volatility is different. So, for instance, going along with more of like an airline type thought process, Boeing is a little less volatile than let's say Apple at this point. Although Apple in the past has maybe not been as volatile, but it was volatile to the upside, and consequently it was actually volatile to the downside. So we try to adjust our portfolios and really try to take a look at that and say, hey, what kind of transportation is meaningful right now? Another good one is FedEx. FedEx is one of the stocks that we own and that we incorporate into our portfolios. It's great because it's up 4% today, and that's why I mention it. But those are the kind of companies that we're trying to look for to balance out maybe some of the more volatile stocks that could be in our portfolios from time to time. So.
Okay, thanks. I appreciate that. That helps a lot, because I know I like to tell people when we're talking to them that when the market's going great guns, if they're our clients, the market's going great guns, they're going to the cocktail parties or whatever, they're never going to be the ones that get to say, oh, yes, we're up, 42%, and doing just, we're beating everybody. I said, but on the other hand, when the market goes down and all your friends are going up to the 5th floor to jump off, you won't be jumping off, because we try manage that risk to the downside.
Yeah, and for people that are on this call, I mean, the beauty of it is if you go to that cocktail party, there are stocks that have actually done really well. For instance, if you're in one of our portfolios, you own CVS. Well, we've doubled our money in CVS. We've doubled our money in Visa. We've doubled our money in Natural Vitamin Cottage. So, I mean, there's stocks that we have gone up 100% on. Amgen, we own Boeing. We're up 57, 60% on Boeing. So, I mean, there's always stocks to talk about. But then conversely, there's always stocks that do go down as well. We also own some gold. And although it's very minor at this point, and we've stayed that way purposely, we own some gold, and it's down. If anybody hasn't noticed.
Hard not to notice that.
Yeah.
Okay, Troy. Well, listen, I really appreciate your time today. And
okay.
Have you got any final comments you want to make?
No, that's it. I mean, I invest for the long run. I mean, that's the idea. Even when people tell me that that they're going to retire in 3 years, well, you're not going to pull all your money out in 3 years and spend it all in that third year when you retire. You're generally going to live beyond retirement, and you want to have money for the long run, which means a good balanced portfolio, in my opinion, is the best portfolio to have. So.
Great. Thanks, Troy.
Okay.
Well, folks, those of you that are on the call that are currently clients of ours, I feel sure that after this discussion with Troy, you feel even better than hopefully you've already been feeling with your investments and how we handle your portfolio. For those of you that are not clients, I'd like to make an offer to you, a couple of things. Number one is that at no cost, no obligation to you, we're happy to take a look at your current portfolio and pass it on to Troy and let them take a look at it and give you some analysis of where they see and we see that you are, and then give you some advice as to what we think, possibly you could do to improve your portfolio. The second thing is that I'd like to offer you is Troy mentioned it early on in his comments, his 2013 mid-year outlook. That is something that we have printed up, and I'm happy to send that to you via email or regular mail, however you would like, and let you read through that as well. So if you have an interest in either one of those two items, I would encourage you to give us a call here at Newton Financial Network, 704-552-8689. You can ask for either myself or Sarah Beth, and she can set up a time for us to talk and take a look at that portfolio or get that mid-year outlook to you. You can also email me at ednewton@newtoninvestments.com or sarahbeth@newtoninvestments.com. I want to thank everyone for being on the call today. And Troy, I want to thank you especially for taking the time out of your busy day to chat with us for a little bit. And with that, Jeff, I'll turn it back over to you.
Good. Thanks, Ed. Thanks, Troy. And again, the best way to get a hold of Ed is to call him at the office, area code 704-552-8689. Thanks again, everybody. And if you have any questions, give Ed a call, whether you're listening live or on the replay, and we'll hope to talk to you soon.
Have a good day, folks.
Thank you.